So, unless you've been living under a rock recently, you would know that I got into Uber stock when it was about $61.44. Now, by living under a rock, I mean you're not on the Discord. I highly encourage everybody that watches my videos regularly to join that Discord linked in the description to keep up with what I'm looking at, what I'm buying, and what the other members of the Discord are looking at buying. It's always free. I'll never charge you to join the Discord. Now, Uber is one of these stocks that has the coveted strong buy consensus from analysts, with the lowest 12-month target being $77, the highest being $120 as of the time it was pulled into this data feed. Now, I can't tell you where the stock will be in 12 months, but I can tell you that recently the business has certainly looked like it's improving in terms of profitability and everything else. However, the price took a nosedive and didn't really reflect that because of a lot of bearishness around Waymo and Tesla robo taxis, which, of course, as you know, are just everywhere and nobody uses Uber anymore. And I'm being sarcastic about that. But the revenue, as you can see, has continued to climb over the last several years to several times what it was as recently as 2020. Now, there was something in 2020 that happened that caused a temporary dip in revenue, but as you can see, they've gotten back to their growth trajectory. It's not extremely rapid growth, but I would call it solid, respectable growth in the top line. But this is not the thing that is, in my view, the most impressive about Uber. What I'm starting to really like about Uber is the fact that it really seems like they're starting to pull the profitability levers at last with this climbing free cash flow per share. I'm liking to look at the per share number at the moment just because there has been slight dilution, although from what I've heard, we're expecting them to do a buyback program soon, and that will simply make this even more attractive because, frankly, if the stock price doesn't recover as rapidly as the business is improving, then of course we would want them to do buybacks, which would be accretive to shareholders, which will just drive up the per share numbers as the share count decreases. And I think a lot of that also has to do with getting stock-based compensation kind of under control at a more reasonable level. So definitely keeping a close eye on the share count in the coming quarters. But all in all, they're still managing to drive that profitability. And how have they done this? Well, I think it comes down to the fact that they've gotten people more or less addicted to the convenience of their product, right? I remember a few years ago, if you wanted to, order food or even rides in some cases back in the day, it seemed like there was always some kind of like a special thing where if you had the app, you'd get notifications on your phone about discounts and this and that. And I see less and less instances where they have like screaming deal discounts in a lot of things. And basically, even even without those, people are continuing to sort of out of habit wanting to have that convenience of either getting a ride right when they need it, or going on to Uber Eats or Postmates, which are both owned by Uber, and getting that food that they crave delivered without having to change out of their pajamas to go actually go to a restaurant in person. And they do have a subscription model as well, Uber One, and I do know some people that have it, and they say if you use the services that Uber has regularly, that it is a pretty good value. Now, it's not quite an Amazon Prime or a Costco discount club membership, but I do think that that could be something that they build upon in the future. So that's also something to maybe keep an eye on. And then finally, we move over to the balance sheet, where you can see that during most quarters that they've had a pretty substantial net debt of up to $5 billion in some cases. And recently, they've gotten to the point where cash, short-term investments, and receivables have now exceeded the amount of debt that they have on the books. They do still have debt. It's just that now things that count as sort of cash equivalents, easily monetizable short-term assets, have now exceeded the amount of debt that they have slightly, to the point where I would say this is a balance sheet that doesn't show a whole heck of a lot of risk. Heck, even when the debt was a little bit higher, I don't think it was that bad for a tech stock like Uber, with the amount of profitability levers that we know now that they have. It shouldn't take them long to dig out of modest amounts of debt. But I do like to see that ultimately that debt is not going to be a major drag on this business. And this is my favorite number to look at for that, for just like a quick temperature check of the balance sheet. As other assets like properties, plants, and equipment, for example, can be a lot harder to monetize than simply cash, short-term investments, and things like that. Before I say my piece on valuation, I would just like to remind you that I have partnered with Moomoo, who provides an unmatched 8.1% APY on uninvested cash for the first 3 months on any cash sweep account, plus 15 free stocks when you deposit $1,000. Follow my link in the description below. You'll get 100 different trading indicators and all the bells and whistles of the premium brokerages, but without any monthly fees. Now, onto the valuation and my thoughts on Uber to close it out. So, why is Uber attractive to me today? When you look at what has happened since they've had consistent free cash flow positivity, the free cash flow has grown faster than the share price. How do we know this? Well, one, the per share free cash flow has been going up. That's indisputable. But two, the price to free cash flow has been getting cheaper. That means that they are growing the free cash flow faster than the stock price is appreciating. That to me means that basically you can pay a lower cost per dollar of free cash flow today than you could have a while back. Now, granted, if you could have confidently known about this growth ahead of time, it still would have been a good idea to buy. I'm not saying that people who bought a couple years ago made a mistake or anything, but what I am saying is they still have profitability levers to pull and a lot of growth ahead. And today we have a much more reasonable valuation for what they're already doing, which means you can be a little bit more confident in a lot of the projections because now there's more of a track record to go off of. Now, granted, yes, the earlier that you can identify an opportunity confidently, the better. But this is where I look at it and I say, okay, this is almost too good to ignore now. They've really executed, and I have good reason to believe that they can continue to execute going forward for a period of time. Granted, yes, at some point the growth slows down, the company matures, etc. But Uber's in a lot of different markets around the world. They're not only in the US, but they're in many other countries. I think 60 or 70 countries total. One of which is India, which is, I think may already have passed China to be the most populous country on Earth. And not only that, but in the countries where they aren't, namely like mainland China and several Southeast Asian countries like Singapore, Thailand, the Philippines, Malaysia, etc., they are invested in their own equivalent in those areas. For example, the Singaporean rideshare app Grab, of which I am already heavily invested. Uber owns roughly 14% of that. So I'm double exposed, I guess you could say, on that, but I'm comfortable with that because the business model is so good. It's based on convenience, and there's a flywheel effect for sure. There's a possible upcoming, precipice with subscriptions, growing potentially in the future. They have a lot going for them, and I don't think that robotaxis and Waymo are enough of a bear case in the medium term to say, no, this has to be a pass because that's so scary. That doesn't really worry me all that much, and I really find the stock attractive at these prices. Granted, it's gone up a little since I bought it, but I don't think the mid 60s is terribly stretched either, to be perfectly honest. If you made it to the end, I'd like to thank you very much for joining us for today's video. Also, if you want to support me, make sure that you, first and foremost, like for the algorithm. Second, subscribe so that you're shown more of my videos more often. Then consider possibly becoming a channel member. Looking forward to maybe doing more things specifically for channel members when I have more of them. Also, you can follow me on the X platform at Mr. Macho Mog. I'm trying to grow that, but it's a tough grind and it's a bit of a slog on there. So any support I can get there is greatly appreciated. Also, just make sure that you catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live. If you liked this video on Uber, we did a whole episode with Aria at Quality Invest 5 on Twitter. Go check that out on Cashflow Kings Live YouTube channel. Take care, everybody. See you later.